So I started the recording, yeah.
All right, well, thanks everyone for coming along again. It's good to see we've still got plenty of people logging in. I know we've got plenty of people that have been looking at the YouTube channel as well later on. So it's good that people are enjoying these, and yeah, we'll keep doing them for a while yet. And although we are finding that there's less and less changes happening in terms of what's going on with the virus, etc. But people are still enjoying these webinars. So yeah, we'll keep doing them for a little bit. So our agenda today, a bit of an update on what's happening in terms of the virus, a bit of a market update, and we've got Gil's Insights, which I know is always eagerly anticipated. Then we've got time for some questions, and yeah, that's about it. Should be, again, about 30 to 45 minutes. As usual, if you've got any questions, use the chat icon, because everyone's on mute. We'll try and get to your questions either as they come up or at the end, but we will get to them. If you have any troubles with your sound, sounds funny, but try turning your video off. That may help. And we're going to record this session, and if you want to get a copy of it, we can make that available. It's also going to be on our YouTube channel, and we send out that link every week when we send the link to the next webinar. Okay. But our usual disclaimer there, everything we talk about today is general. It's nothing to do with your personal circumstances or goals. Obviously, if you want any more personal advice, talk to your advisor. We're always happy to talk to you. But this is not meant to be aimed at any particular individual. Okay, just a quick recap of what we've dealt with in previous webinars. Obviously, they're still all available on the YouTube channel, so if you want to log on there using the link that's sent out every week, you can jump on there and check those out, or just let us know and we can send you a copy. The government stimulus, we've covered all these, so I'm not going to spend any time on them, but reduce the amount that you can draw from your pensions. So again, if and we've talked to a lot of clients about this, if you feel you need a little bit less money at the moment, then it may not be a bad idea to reduce your pensions a bit. But I'm still encouraging people that if they need the same amount as they needed before, then keep taking it. In most cases, we've made sure you've got sufficient cash there in your account. It's not going to be too detrimental for you to continue to draw that if you need it. But where you don't, because we are finding a lot of people spending a bit less, then have to think about maybe drawing a little bit less. For those people on Centrelink payments, a lot would have got the $750 payment a few weeks ago, and then there's another one due in July. There's also the extra $550 a fortnight for people that are on the job seeker payment. They're job seeker, spell that one wrong, then job keeper. So they're basically job keeper is $1,500 a fortnight paid through your employer. So that's been a big bonus for a lot of people to keep them attached to their work while they're not able to, their employer isn't able to keep them in a job. And the other one that's been in the news a little bit of late, the early access to super. So you might have seen some of the issues they've had with that, with some fraud problems. They say they've got on top of that now, but yeah, we've seen a huge amount of people accessing their super early, up to $10,000 this financial year, and at the moment something similar going to be allowed next financial year. So it's been something like $10 billion taken out of super through that scheme already. So yeah, we've talked about global economic indicators, the Chinese coal and steel demand, Chinese PMI, London Interbank overnight rate. Talked about the Reserve Bank outlook and the downturn in economic activity and what a healthy recovery looks like. Okay, so a bit of an update of where we're at now. The virus in Australia. So we had no new cases in New South Wales on Monday for the first time since February. So that's been a real positive. And the other thing we're seeing is they're really ramping up testing, and through that, there's been very, very few cases found in the community, which is really fantastic. And obviously, if we can limit the amount of people walking around with the virus, then it's going to dramatically stop the spread. And seeing no new cases on Monday was fantastic. And I haven't seen the figures for yesterday as yet, but it's very good signs coming out of New South Wales, and good signs particularly when there was a bit of concern about what we might see with some of the easing of restrictions the weekend before that. And at this stage, that hasn't seemed to have led to an increased number of cases, so that's a good sign. WA has had no new cases in over a week, so they've done an extremely good job of shutting things down, and they're now looking to open things up probably a lot quicker than other states, because they've sort of isolated themselves as a state there. So there's going to be a lot of further easing in most states this week. A lot of states from Friday are announcing various easings of restrictions. I know in New South Wales they're going to be allowing up to 10 people in restaurants and cafes. Interestingly, a lot of cafes are saying that with only 10 people in there, they're probably not going to bother opening. So it may not really make much difference to what you notice in terms of things being open, but it's definitely a good sign that things are getting better. Prime Minister announced the 3-stage easing program. So, just announced, what's going to be in each step, and a bit of a rough outline of what time frame may be. But he also did say that, he fully expects there's going to be setbacks along the way, that, it's quite possible that, we ease restrictions and then have to put restrictions back on again if things start to become a problem. So, but the focus now very much is on, getting things back up and running. And the Prime Minister said they're aiming for a full reopening of things by July, which would obviously be fantastic. Look, there's a lot of water to go under the bridge yet, but again, all signs are looking pretty positive. Globally, figures across the world are still slowing. There's some areas such as South America where there's still a little bit of concern that cases are growing there, and but in general across the world things are slowing. US is still obviously a bit of a concern, but their numbers are slowing dramatically as well. So yeah, there's good signs there again. We did have a new outbreak in China over the weekend, which started to raise concerns again that there could be a problem there. But they had no new cases yesterday, and so it seems like they've got that under control again. South Korea was a bit of an example of where easing of restrictions can go wrong. They had opened things up a fair bit, and they had an issue with a new outbreak from a nightclub in Seoul, where someone that had been tested, that was positive, had been there, and there's been 60 odd new cases just from that one event. So it does show that we need to be careful with easing of restrictions, but they've again seemed to have got that under control. So what I thought I'd talk about now is the economic outlook, and rather than, we're still very positive about what's going to happen going forward, and we do think that the recovery will be strong and will be reasonably quick. But I did want to also present the bear case, the negative case as well, and I'll present the positive case too. But I think it is good. While we are, as I said, quite optimistic, I think it's still good to be aware of the risks on the downside as well. Obviously, the first risk is we get a second wave of infection. There's concerns about if we ease restrictions too soon, and people start taking things for granted and don't take the precautions that they have been taking, and we see that second wave start. Second risk is that the rebound has been overstated. There is a bit of concern that if we sort of keep these social distancing measures in place for quite a while, that we won't see that sort of sharp bounce that we're kind of expecting. So, things like opening restaurants but only allowing 10 people to be in there, that's going to stop a lot of restaurants from opening. It's also going to discourage a lot of people from going, I think. So, that is not going to see sort of the sharp bounce that perhaps we'd see if things just, all opened up immediately. So there is a bit of concern that doesn't allow the sharp rebound. There's also some concern that people continue to, with uncertainty, save some money because they're not sure about what's going to be happening, and that demand is a bit softer than expected. What we're hoping for and what governments are trying to do is make sure people have got money in their pocket and they've got confidence around their jobs, so that instead of saving money, they're out there spending, and that demand is strong. Third risk is the valuation of shares. For example, in Australia, the ASX 300, so the top 300 companies, are only down about 18% in terms of value, but the earnings, they're actually down about 20 to 30%. So there is some talk that perhaps some of these companies are still overvalued. On the flip side, their earnings may be down 20 to 30% at the moment, but there's an expectation that that's not a long-term thing. So we expect to not see too much reaction to earnings figures at the moment, because we think the market's factored that in, and we don't expect current earnings to necessarily reflect what's going to happen going forward. Another thing is technical resistance. So a lot of, as Gil's spoken about before, a lot of the trading in the market is done by computers. And a lot of that is done on what they call technical analysis. So they look at the figures that the market has got to, and using certain algorithms, they try and predict what the market's going to do next. So at certain points, what they call a resistance point is where they expect that the market would fall. The US market is rapidly approaching a key resistance point, which may be difficult for it to overcome in the short term without sort of significant good news. So that's that may slow down the US market a bit. And the other issue is politics. We've got a US election coming up, which hasn't got a huge amount of attention at the moment, but it will. And it looks like it could be a fairly tight race again. So again, that's just adding a bit of uncertainty to the market, which is never a good thing. So that's our doom and gloom scenario. What we think is a bit more likely, as I said, we're still pretty optimistic here, is the bull case. Governments are still pumping huge amounts of money into the economy. It's not quite at the levels of the GFC yet, but it's pretty close. And basically all that that liquidity and free capital needs to go somewhere, and it's ultimately going to end up in asset markets, whether that be share markets, property, gold, bonds, whatever. It's going to end up there rather than sitting in the bank where it's earning nothing. Another possible positive is we get a health breakthrough. So we're seeing vaccine trials being brought forward. There's a lot of positivity around there. There's no concrete announcements or anything yet, and these things obviously take quite some time. Although everything's being sped along in this case, but there's a lot of positivity there. There's also increasing evidence that there's existing drugs that can really slow down or help the symptoms that people are having. So that's another positive. There's an increasing number of companies now that think the economy hit its low in April. So that's again good, and that shows that companies are quite optimistic that things are going to get better from here. And I think we're seeing that already, that while restrictions are still in place, businesses are finding ways to operate still. There's obviously a lot that still can't, and hospitality has really struggled, but a lot of those businesses are doing takeaway and delivery and that sort of thing, and are managing to get by. And so I think I would agree that we have seen the worst of it in terms of the economy. The other thing that could be a real positive is if sentiment changes. At the moment, the cash levels held are as high as during the GFC, which is, people were holding huge amounts of cash at that time because they were, quite scared about what was going to happen. Any increase in sentiment, any signs that things are more certain, or that they're looking good, there's good news, is going to drive sentiment, and that cash is going to flow through into markets. So there's a lot of upside there. It may not be as sharp a recovery as perhaps we may have thought earlier. If we do see restrictions eased over a longer period of time, it may not be that really sharp recovery, but I do think that there'll be quite a strong recovery, as things do ease. So we're still quite positive, but I think it was important to present both sides. Righto, that's about all I had there. So over to Gil's insights. Do you want me to hand you the screen, Gil?
Okay, sorry about that. I was muted. I think I can take the screen now, Steve. So
yep. I hit stop share. You should
stop the share. Now, are you seeing my screen here, Steve, or not?
Yep, that's it.
Gil's insights on it?
Yep.
There's a lot of really interesting things going on today, everybody. And again, thank you very much for joining in. We're going to keep doing these while you're telling us that you're interested in enjoying them. So there's been some interesting things happening with China. There's interesting things happening in the oil market. There's a few things recovering quite strongly. I want to just come back at the end to talk about what Steve was talking about earlier with the amount of cash that's sloshing around the world and what that means. It's very relevant to industry super funds. It's relevant to Australia. It ties back to Paul Keating and a little bit at the end as well. So the first thing I wanted to talk about was that every week we do this little graph showing the trend lines in the different countries around the world. We've managed to turn this into a video this time. So China, you can see taking off, and it was about this point where the other countries start to come in. China got about 20 days or so into it before it affected the rest of the world. And that's very, very relevant in terms of what's going on with the international relationship between Australia and China at the moment. We're seeing some very interesting things happening on this graph. The United States has finally taken things seriously and recovered. The interesting thing for me in this graph is where Sweden is and where Japan is. I'm going to show you some figures in a minute that talk about the intensity of the response from the various countries around the world and how that's impacted on the spread of the coronavirus. The reality is the quicker you responded as a nation, the quicker you stop this thing. And I think what we're going to see going forward, particularly when you look at the political dimension, is that governments are going to be far twitchier about these sort of things going forward. We're going to see a lot of medical technology scanning us in the airports and so forth, and a lot of movement towards encouraging everybody to have something like the COVID Tracker Act on their phones, so that Google can basically identify whether there is an outbreak weeks and weeks before any traditional method. So we'll look at that in just a second. This one's a really interesting table I put together this morning, and what it does is it sort of correlates the responsiveness of the various countries. Now, if we look here at China and New Zealand and Australia, so we're here with these guys, they're green because their response was fairly instantaneous. We either had strict shutdowns in China and South Korea. Now, I will admit I'm not 100% confident in the accuracy of the Chinese data. We've seen enough questions asked there that I'm not going to review those. What I will look at, though, is the infection rate per 100,000. In China, it was significantly lower than Korea and New Zealand and Australia. Australia's infection rate, I feel, was largely correlated to the Ruby Princess and so forth. But the bit that I find really interesting is the death rate per million people of the country. So obviously China, being the larger country with 1.4 billion people or so, has a high number of deaths, but their actual death rate, because they shut the area down, was very strong. Australia and New Zealand have similar extremely low death rates. Canada, being closer to America, actually was slower with the social distancing. Being relatively similar in scale and nature to Australia, what is really telling here is the infection rate for Canada is arguably about 6 to 7 times higher than it was for Australia. So 27 people per 100,000 instead of 190 people. And likewise, your death rate has gone significantly through the roof. Now, when you look at the US, which really did it, the reality is that the Americans argued about the financial impact of social distancing for much longer than Australia did. And again, I actually really see this as a strong piece of evidence for how intelligent and wonderful a country this is to live in. We just got a panel of experts together and said, is this serious? Yes or no? What should we do? Yes or no? And we just did what they said. And we see here a monstrously different response rate. Instead of having 20 infections or 27 infections per 100,000, the Americans and the Swedish, we'll talk about the Swedes in a second, 400 odd infections. So that's a rate somewhere in the order of 13 times higher, and their death rate per million people is monstrously higher. It's about 60 times higher in America per million people than Australia. Now, Sweden was a really interesting country. I'm a good little corporate citizen in the sense that if the government says we're doing this, I'm going to obey the rules. I may disagree with their thinking, but if they say we're going to do it, we're going to do it. Now, the Swedish decided to trust their people a little bit more. The Swedish decided to just allow the population to take this a bit more seriously than, they allowed the population to obey rather than mandate the rules like Australia did. So that's why I've called it a relaxed social distancing arrangement. Now, for a country with less than half of Australia's population, their infection rate is 4 times higher than ours. Their death rate is 60 times higher than ours. It's staggering. So the truth is, even amongst a highly educated, very obeying and well-mannered population like the Swedes, if you didn't apply the social distancing restrictions, then it became a big issue in their country. Now, they've only had 27,000 people, but that's significant in terms of the number of hospitals and so forth. Their death rate is significantly higher than ours. And when you look at the UK, Italy and Spain, which is what we would call a delayed shutdown, where they faffed around and just didn't do it. And I believe as only as late as last week, the UK have only applied a 14-day waiting period for the for people coming into the country. We're seeing significantly worse figures, much higher infection rates. Again, in the 300s and 400s, death rates are in the 500s. So the truth is social distancing works. The truth is our government, New Zealand's government, and to a certain extent Canada's government, but we're better in that sense. They trusted the population obeyed. They didn't do what they did in South Korea and China, which was far more prescriptive, but the result was almost exactly the same. So the learnings from this, I think we're going to see, is that governments are going to be more responsive to this in future. The truth is the economy does seem to be tickling along all right, but I think the hospitality and travel industries are going to be, they're going to be in for an interesting 5 or 10 years as we figure this stuff out. Now, there is one column I haven't talked about yet, which is the normal death rate per million people in this country. So yes, we have lost 4 people per million, but normally we lose 7,000. So to put it another way, 7,000 people die of something else for every 4 people that die of COVID-19 in this country. And we are clearly past the worst of it. Yes, we're going to have to be careful about renewed outbreaks, but the responsiveness of the population in the country to this has been really good. But again, we need to really observe here that it doesn't matter what the media tells you, the chance of this being a problem is quite modest for any Australian or even for an American. The number of incidents in the Hunter Valley, I believe, for the last week's basically 0. I know Steve was saying earlier that he was feeling pretty ordinary, so he had himself tested at the drive-through testing place in Newcastle, and he's fine. We're all, I think our families have all got different bugs and coughs and splutters. So that's happening, but that's what normally happens in May of every year. So that's a fairly good way to look at it, I think, that the intelligent response that this nation and New Zealand have taken has proven to be as successful as anywhere in the world, including the draconian countries. China's response, China's figures, I have question marks about, but it's still a good story. Now, I want to show you the, hang on, I just need to go back to my pen. This is an interesting graph. Now, Steve gave you some figures on the returns in the stock market. This was just one I grabbed. Now, rather than showing you Australian stock market again and again and again, I thought we'd grab the US market in this instance. Firstly, the horizontal line is where the market was in the US a year ago, and it's where the market is today. So the US stock market is actually up by a fraction of a percent from 12 months ago, which is a very positive story. We are, and forgive me, there's a bit of a typo there with the S&P 500. We are down, or the Americans are down from where they were 2 months ago or 3 months ago, but they're only down 15%. So now we would actually put this COVID-19 crisis into the category of a normal bear market rather than the catastrophic one we had in late February, March. The recovery has been quite consistent. Now, to support Steve's points earlier, the reason the markets have recovered is because the markets are looking 6 months ahead going, I think we're going to be okay. And in being okay, they're factoring in where the market should be in 6 months, not necessarily where it should be today. One of the things that isn't widely understood is the sheer amount of cash in the world. Now, there's always been an equation where the what they call the real rate of return, which is a rate of return above cash and inflation, has never been wider in some sense. What that means is if you can get 1% sticking your money in the bank, or you can get a 4 or 5% dividend buying bank shares, there's a very strong argument to put your money into the stock market. So even if the bank shares are only providing a 4% dividend or a 3.5% dividend, that's still far superior to getting 0.5% in the bank account. So we're seeing here at the moment a monstrous amount of money sloshing around the world looking for a home. Now, when the fear and uncertainty passes, that money is going to start looking for a yield or looking for an income. And that income takes the form at the moment with interest rates basically at zero. That income takes the form of dividends from the underlying share market. Now, this is going to be really interesting for Australia because the Americans traditionally don't pay great dividends because they tax American companies and then they tax the shareholders a second time when they receive the dividends. In this country, you only get taxed once, which is why the Labor Party lost the last election, where the dividends that come out of the Australian companies are taxed, yes, but when you receive a $100 dividend from the Commonwealth Bank, for example, as a shareholder, you also get a $40 franking credit that's attached to that. So in effect, a dividend from the Commonwealth Bank of $100 for most of our clients that are retired and paying no tax, that dividend is equivalent to a $140 dividend because you do actually get the tax credit refund at the end of the financial year, as Mr. Shorten and the Labor Party realised to their distress, Australians actually like that they're not being taxed twice. So when you look at what's going on in America, where there is a monster amount of money, and Europe, there's a monster amount of money looking for a home that's going to give them some sort of yield, what they're going to do is to start to look to the higher yielding stock markets that are politically stable. And that is one of Australia's key advantages. I think people have heard me say this before. If you went back 100 or 120 years and you put $1,000 in the German stock market, the British stock market, the American stock market, the French stock market, and the Australian stock market, there's a lot of debate about which would be the highest return. The truth is Germany's stock market did the worst. They went through 2 world wars and they lost. The French were the second worst. The Brits and the Americans, so the Germans are about $35 million, $1,000 share would be worth now. The French were around the 40 to 50 million. The Brits and the American $1,000 portfolio turned itself into a 60 to $65 million portfolio. Australia's market returned $130 million. The reason? Because we have always focused on dividends, and companies in this country, because of the way the Corporations Act work, required to focus on returns to shareholders. In America, they tend to keep the dividends to themselves, and that's why there's a lot of mergers and acquisitions in America. But you get a lot of companies that might be very good at making, cars, decide that they're going to go into the food business because they've got so much money. Someone sells them the idea of a high yield restaurant chain, but it turns out the car manufacturers aren't very good at running food businesses. So we see a lot of wealth destruction in America, whereas in Australia, the dividend gets paid out to the shareholder. And as a result, it's very much what I call the Jerry Maguire kind of market, which is show me the money. Don't tell me what you're going to do for me tomorrow. Show me the money you've made for me today. So I see that as a very, very strong argument that when the world settles down and the money in the world goes looking for a high yield home, we're going to see a lot of support for Australia and the Australian market. Now, on the flip side, I want to come back to Mr. Keating, who created the mandatory superannuation system for Australians back in the 80s. Now, that in itself is he turned the nation into a country of savers, which is terrific. And those country of savers have invested in roads and bridges and houses and mining companies and banks and all sorts of things. So every single one of you has a broad portfolio of shares, at least in part in your portfolio. Now, one of the things that we didn't really understand at the time, but I dare say Keating knew this from the beginning, was we have now one of the largest investment markets in the world, massively swamping the size of our actual economy. We're somewhere like 1.3% of the world economy, but we're a much, much larger percentage of the world stock market. And the reason is we're actually one of the wealthiest nations in the world in terms of capital. We covered that last week when we were looking at the income per Australian. But we actually have this monster pool of money, 2.7 trillion, minus a little bit that's been paid out to people in the last few weeks. $2.7 trillion in the superannuation system. and that is capital looking for a home. So we're going to have the world interested in our market. We've got the superannuation system in Australia interested in our market. And to be truthful, the industry funds are going to find themselves under a fair bit of pressure after their decision to put a lot of money into what are called unlisted assets, which are basically property assets and companies that can't be easily sold in the event of a downturn. So we're going to see a little bit of an extraction of industry super fund capital from that side of things over the next few years. And all of this is going to be supportive of the Australian market. Now, I did a bit of digging around just to see who are the winners and the losers at the moment. I don't think anyone can doubt, if we look at the losers first, airlines, the big losers, hotels, restaurants, conference centres, concerts, recreational venues, they're all struggling. There's no doubt about it. People aren't allowed to go out, let alone wanting to go out. We're seeing commercial real estate. The truth is, working from home is kind of working, not brilliantly, but certainly it's more of an option perhaps than we'd ever considered before. I know that I'm quite comfortable with the idea of maybe doing a day a week of phone and computer meetings from home. It's rather enjoying spending more time with my family. Residential real estate struggling as people are losing their jobs. Retail obviously is hammered, although online retail is doing well. I think we've discovered that sporting heroes aren't in fact heroes, they're simply entertainers. But we're moving on. Car dealerships, now is a very, very good time if you're thinking of upgrading your car. Trot in to see the vehicle dealerships over the next month. They all love their turnover up to 30 June. And I've heard anecdotally, particularly in some of the more expensive European car brands, that they're down up to 80% in sales in the last few months. So if you're thinking of it and you've got the money put aside, maybe, just maybe. Now, construction is an interesting one. There's a lot of property still being built, but from what I understand about the residential building industry, people aren't buying off the plan anymore. So we've got racing. There's going to be a slowdown there. Well, there has been. Now, as to the winners, people that deliver food, supermarkets. I know Bunnings is doing very, very well. Anyone that's involved with online interactions, such as what we're doing today, the Zoom meetings or workplace collaboration, going through the roof, absolutely going through the roof. Home delivery and logistics are doing well. I don't know why, but white goods retailers are doing well. I think what's happening is people aren't spending as much money leaving the home, so they're upgrading their fridges and their washing machines, but so be it. Biomedical companies, anything related to the health industry is doing well at the moment. The funeral industry, obviously, but the death rate actually isn't statistically changed very much at all from before COVID-19. It's just a slight wrinkle. Social media, dating apps for any of you that are single are doing well, and power and liquor stores. One of the truisms is that the first two industries to do well in a downturn are gambling and alcohol. So I don't think that surprises anybody. Now, just go to the next slide here. This is quite an interesting graph. I think Scott Morrison, ScoMo, may have secured himself another term with the way he's acted here. The media has certainly done everything they can to turn this into the biggest event in 10 years. When you see here the correlation with the approval rating, the slower the country reacted, the lower the approval rating of the leader. So Australia and Canada are doing well, Angela Merkel in Germany, Boris Johnson, I think there's a bit of sympathy as he got sick there, but Britain's struggling a bit because they haven't managed to close the borders like Australia has. India's hanging in there, but we're getting down towards Trump, Shinzo Abe in Japan, and the president of Brazil. Both those countries have actually had a fairly ordinary response to COVID-19, and the leaders are suffering as a result. So again, this particular chart says to me that we're going to see our political leaders reacting more and more to these sort of things going forward, which suggests that we're all, whenever we travel, we're going to go through scanners and things like that. and there may be some form of pressure for us to have a mandatory health reporting app on our phone going forward, which I find, I don't know how I feel about that, to be truthful. On the one hand, it makes perfect sense as long as it's anonymous. On the other, I've downloaded the COVID-19 app, but I'm just not sure I want Google knowing everything about me. Here's an interesting graph as we just sort of get towards the end of it. There's been significant change in the kind of hairstyles that people are interested in. This is Google searches, but surprisingly enough, the old buzz cut, the hair clipper cut, how do you cut people's hair with clippers, has gone absolutely through the roof. It's 500% up on where it was a few months ago. Anyone like Steve or myself that thinks a bit of facial hair adds a little bit to our mystique and our good looks, we're joining a much bigger crowd now. For the girls, there was a bit of collapse and then interest in cutting a fringe because your hair's getting out of control, but more detailed work like a perm or a hairstyle, I'm afraid that people aren't going to the hairdressers, and I know my hairdresser's struggling a little bit as well. So it is interesting when you put the pressure on what people forego. So at this point, that's pretty much it. I wanted to just go to the to see if there's any questions being asked at the moment. But as I said again, information, knowing things is not simply enough. Knowing what it means is the most important thing. And I did want to thank the people that are tuned in today, but by extension, all our other clients, because we've spent years and years talking to you about volatility of the market, and it's been an absolute joy to know that you're listening. The market has recovered roughly the way we said it would. We're going to have an interesting, I think we're going to see another bounce in the market when they come out with therapies, viral therapies and antiviral vaccines. That will be good. And then we're going to see our kids and our grandkids struggle a little bit as the youth unemployment rate goes through the roof. My understanding is that we're seeing a lot more strength in employment in the middle-aged side of things. Although I do know of a friend of ours has her own business, and they're starting to struggle as companies are, particularly in the food preparation industry, are struggling a little bit as well. So there are companies that are going to be affected, and there's going to be a lot of transferring of responsibility and work around the country. That said, thank you very much. Virtually all our clients are hanging in there and not panicking, and they're being rewarded as a result. Most people are seeing single-digit negatives, if not less than that, which is tremendous. And it is actually quite heartening that you trust us so much, because whilst we don't know how a COVID-19 scenario turns out for our clients, we do know how markets behave, and the right answer is always to stay here and to just ride the wave, because smarter people than I are managing your money on a daily basis, and they are so hyper attuned to what Donald Trump is saying, what Bojo's saying, what ScoMo's saying, and all these things are being factored in at a rate of knots. So on that, I think we'll wind it up. As you know, we're all here available to take your calls. Offices are still open, and the advisors are still very much available if you've got any questions. So hope you enjoyed today. I'll just scan out of here and have a quick look to see, Steve, whether we've got any questions.
No questions at this stage.
All right, I've got one, I think, from iPad Air number 3. How's the bike? I'm not sure who iPad Air number 3 is, but for those that know, I accidentally slipped on a banana. Oh, it's Ian. How are you, mate? I can see it now. You're going to have to change your the name on your thing. The motorcycle's great. Well, my daughters and I are just enjoying spending time together, and I slipped on a banana the other day, and I accidentally bought a BMW motorcycle. So, Kim, I know you're looking. We'll talk about that later. All right. Well, thank you very much, everybody, for tuning in. I trust you're all well. Please email us or call us if you've got any questions. As always, it's been a joy. We will talk to you next week. Thank you very much. Goodbye.
Thanks, everyone.